12:45 this afternoon. The S&P sits at 75.27. It is red on the day, and it has just cut below a support band that price only reaches on the rare session. 75 minutes later, it is up 27 points. Nobody in that window changed their mind about anything. The desks that bought were not optimistic. They were short exposure they had to cover. And covering it took about $8 billion. This is the AlgoIndex market close for Wednesday, July 15th. 3 reasons to stay. 3. A 30-day record buried in the flow, and it is not in the index. 2. A number the market is quoting for next week that we think is wrong, and the people who publish that number think so too. 1. A bet sized in the tens of thousands of contracts, placed the session before the company reports. The board. The S&P finished at 75.72.40, up 28 and 81 points, up 0.38%. The Nasdaq 100 went the other way, down 0.28. Semiconductors were the weak spot, off about 2%, after producer prices came in softer than expected. The fear gauge closed at 15.66, down 5.15%, and its own volatility gauge finished at 91.85. Demand for protection was not there today. Full day range, 72 basis points, high 75.81 and 50, low 75.27 and 25. Put to call volume ran 1.36, which reads defensive, while the number that decides whether options are expensive, implied volatility rank, sat at 13.5%, bottom 7th of its year. Hold those two together. People bought more puts than calls and paid historically little to do it. Take the session apart, and you get leadership, flow, and mechanics. Only one of them explains the reversal. Leadership first, and it is strange. Apple closed at an all-time high of 328, while the Nasdaq 100 closed lower. I will come back to that, because I cannot fully square it. Flow second, and this is the day. Index options produced $1.5 billion of hedging flow, mostly zero-day call buying and put selling. Individual stocks produced $3.2 billion, and that money went into longer-dated calls. Now, separate out the 7 largest companies on their own. $3.7 billion, the highest single-day reading in 30 days, almost all of it in longer-dated upside. 2 weeks of earnings from those 7 start next week. Somebody is positioning early, and they are positioning long. Mechanics third, and this is your 12:45. Dealers sit in positive gamma right now, which means their hedging works against the move. Price falls, they buy. The end-of-day options read measures the hedging flow behind the S&P, swinging from minus $4 billion to plus $4 billion between 12:30 and 2 o'clock. $8 billion of delta bought inside 90 minutes. Our own 5-minute bars put the low at 75.26.95 at 12:45 and price back at 75.70 by 2. 43 points bought back in 75 minutes by people whose models gave them no choice. One caution on that. The read puts the rally at 63 basis points. Our archive supports closer to 55 at 5-minute resolution. We are speaking our own measurement and borrowing only their 8 billion figure. Walk the day, because every turn landed on a line that existed before the opening bell. At 7 this morning, before producer prices printed, the options read names 2 numbers, resistance at 75.80, support at 75.20. 10:20. High of the day, 75.81 and 50. 1.5 points through the resistance call. And that print was also a new 1-month high. 12:15. Price slices 75.35. The volatility inflection level, the line where dealer hedging changes character. 12:45. Low of the day, 75.27 and 25. Standard pivot analysis puts the third standard deviation support band at 75.29 and 72. The low went 2.5 points under it and stopped. Sitting just below that, roughly 7,000 zero-day put spreads at 75.10 and 75.15 were absorbing the selling. By 1 o'clock, 75.35 is reclaimed. By 2, the day is green. The clean map into tomorrow. Gamma ceiling 7600. Computed pivot 7560. The inflection at 75.35. And the strike that matters most? 7,500. Taiwan Semiconductor reports tomorrow morning. The latest flow report, which covers Tuesday's positioning, shows a September call spread opened in that name. Roughly 17,000 contracts bought at the 450 strike. Roughly 17,000 sold at 530. $52.5 million of premium. $323 million of delta. The stock was 420 and change. The long strike is 7% above it, the short strike 26% above. That structure does not pay on a small beat. It pays if the stock leaves its range and keeps going, and it was put on the session before the print. This is the part worth your attention. Implied volatility on the S&P closed at 12.77%. Realized volatility, what the index has actually delivered over the past month, is 14.92. Options are priced below what this market has been doing, not equal to, below. Fixed strike volatility fell again today to its lowest level in 30 days. And at-the-money implied volatility for next Monday through Wednesday has dropped into single digits. Now put a calendar next to that. Friday is monthly expiration, and expiration removes much of the single stock gamma that has been holding this index still. Monday is the first session without it. Alphabet and Tesla report Wednesday after the close. Single digits is the price of a week in which nothing happens, and that week contains the two largest scheduled events of the month. The people who publish that read say it plainly. Implied volatility may be underpricing the event risk. Their morning note goes further and says they want to hold protection. Here is the tension, and I am not going to resolve it for you. Tuesday's flow shows someone selling 46,649 calls on the fear gauge at the 24 strike, expiring August 19th. That is a large bet that fear stays where it is. On the other side, 12,500 August 5th call spreads, bought at 25 and sold at 40. One desk says quiet, the other pays for a spike, but not a catastrophe. One more honesty note on that report. Its summary calls positioning strongly bearish, driven by put buying. We opened the underlying prints. The two largest S&P put lines are 50,000 bought at 6,100 against 51,000 sold at 6,200. Same August expiry. 100 points apart. Read together that is premium collection 18% below the market, not fear. The largest single stock put line is 42,000 contracts sold, not bought. Size is not direction, and we are not going to tell you the institutions turn bearish when the prints say something more complicated. 5 setups reviewed, 4 filled, 1 winner, 3 flat, no losers, and 1 that armed and never triggered. The winner was the NASDAQ strategy, and it deserves an asterisk we are going to say out loud. Its target at 29,546.72 was touched twice, at 10:45 and again at 11:20. Both times price closed back above it. Our exit logic evaluates closed bars, not touches, so the automatic exit never fired. The operator closed it by hand at 11:23. That is a win in the record and a gap in the machine. The touch-based exit exists in our code and is switched off. Today is an argument for switching it on. The 3 flat trades are the environment doing exactly what the environment does. Positive gamma, a pinned index, a session that ends where it started. Single leg long options, defined risk, and in a market that gives back everything it takes, break even is the honest outcome. We are not publishing dollar figures on those, because one of the fills is a kind our own rules say cannot be trusted to produce a loss. The chart says flat. We report the chart. Bias, neutral with an upward tilt into Friday, medium confidence. Start with a scorecard, because we owe you one. Last night on this show, we said the market was paying for a band between roughly 74.81 and 75.88. Today ran 75.27 to 75.81. We also said 75.35 was the inflection to watch. That is the level price cut at 12:15 and took back by 1 o'clock. The band held and the level mattered. The map. The highest probability magnet strikes are 75.96 at 99.8% and 75.74 at 99. We closed at 75.72 and 40. 2 points from the second one. That is not a coincidence. That is a pin. Friday's expiration pin on the big index fund sits at 750. about 0.6% below today's close. And 750 is also the largest gamma concentration strike. The pin and the biggest strike are the same price. Our own index level calculation puts the pin one tick differently, at 75.50. We are giving you both, rather than pretending they agree. Calendar. Taiwan Semiconductor tomorrow morning. Expiration Friday. Alphabet and Tesla next Wednesday. We are 0.64% under the 52-week high of 76.20 and 90. And momentum is not stretched. The 14-day relative strength index has more than 200 points of room before it reaches overbought. The ceiling zone into Friday is 7600 to 7625. What changes it? A close above 7600 opens that zone. A close below 7480 turns this bearish and ends the environment that bought your dip today. That is the session. If you want the same discipline applied to your own trades, the AI Journal is free, and it grades every entry against the levels that were live at the time. Start at members.algoindex.com/auth/signup. We publish our level accuracy rather than describe it. Every forecast scored at algoindex.com/tools/gamma-level-accuracy. Written work, including tonight's numbers, goes up at algoindex.com/blog. The trading community lives on Discord, and it is invitation only. One number for tomorrow, 7,500. Biggest gamma strike, Friday's pin, same price. Watch how it behaves, and you will know whether this market is being held or being carried.